These three stocks are selling near their 52-week lows. And when stocks are near or at their 52-week lows, this is a great place to start looking to buy a stock. So stock number one is going to be UPS. This is a shipping company. Current price, $128 on the nose. Now, guys, when it comes down to shipping companies, I really like UPS and I like US Postal Service. I do not like FedEx. Any of you that have been watching for any length of time, FedEx, Steve out there, not a fan of that company. But looking at UPS, this is a very interesting company. I'm going to pull up some interesting stats that we've seen over the years. So let's just look at some analysis real quick. So this is a company that has a market cap of $110 billion with an enterprise value of $156 billion. Now, this difference here is the debt of the company. It is a pretty substantial amount of debt. But when you think about it, think about the labor-intensive and capital-intensive business that this is. This isn't a software business. Yes, they have software, but they have trucks, they have planes, they have huge buildings, they have storage centers, they have so many things going on. I'm not terribly worried. And I bet if I were to go to something like a FedEx or some other shipping company, I bet there would be a similar debt ratio. So I'm not really worried or upset about that. Now let's look at the free cash flow. 5-year average, about $7 billion. Let's compare it to the net income. The net income is a shade higher, but it's so close that I'm not really worried about it. I typically like to see a higher free cash flow than a net income. If we look on an annual basis or a trailing 12-month basis, you can see that it's pretty consistent that they do have more net income. So maybe that's something to pay attention to. Looking at return on invested capital, I'm surprised by this number. This means that they reinvest their money really well. For some type of business like this or a sector like this number truly does surprise me. So just looking at this right off the bat, let's see their gross margin. Pretty decent gross margin. 5-year profit margin. Now this concerns me here. 5-year profit margin, 8%. Profit margin, trailing 12 month, a shade under 6%. So that's declining. What's the reason? Are we coming off COVID? So let's look here at the 8 pillars real quick. These are my pillars up top. Now, here's the debt. Not terribly concerned with that. Free cash flow growth is shrinking. That's something that I want to pay attention to. Before I go any deeper and look at these financials, I want to show you guys this. This is the revenue of UPS from 2008 to 2023. You can see that there was a really steady increase, huge jumps here when everybody was shipping packages, and we've kind of tapered off. So when we look at the profit margin, remember how I was concerned about the 5-year profit margin versus the trailing 12-month profit margin? Is this a reversion down to somewhere in here? You can see that the revenue is dropping. Are people shipping less because they can go and see people? So if we just come to the income statement, let's look. Now here you had a big spike, $74 billion, this is pre-COVID, $10 billion jump, $13 billion jump, another big jump, about $3 billion, and now you have that decline happening. So when I look at a company like this, I say, all right, they are going to return to normal. What is normal? I don't know what normal is. Is normal 75 billion? I don't know. Same thing's going to go for the profit. So let's pull up Stock Analyzer tool here. And I'm going to look at one assumption here. Let's look at revenue growth. So they've done a shade under 5%. Now these numbers include, you can see the big fall, but these numbers include those big jumps from 2020 to 21 to 22. So I'm actually going to go with 3% right there. Profit margin is declining. I'm going to take it to 5.5% just to be conservative. I'm going to do the same thing for free cash flow margin. PE, I'll give them a PE of 20. They're UPS. They are, I think you should pay a premium for them. And a return of 10%. Let's see what intrinsic value is here. Okay, so I'm about $97. $97, if you bought it today, you'd get about a 6.29% return. To me, based on where we currently are, I'm probably setting a watch list price around $95. And that's just to start selling puts or looking to potentially dig into this a little bit deeper. Now, the next stock, Occidental Petroleum. Now, this is a big Warren Buffett stock. Current stock price is $52.76. The 52-week low was $49.91. So Warren Buffett owns 255 million shares valued at $13.2 billion of this company. That's a lot. It's 4.6% of his overall portfolio. His average price is actually above where we're at today. It's $54.48. He increased his position by 1.2% in June. Now, when it comes to oil has always, it's a commodity. So it's a very tough thing for really the average investor to go and look at, because you need to follow what's happening geopolitically. You need to follow what's domestically. You have to follow what's happening with drilling and fracking and this and what's not happening in fracking. So coming over to Oxy, let's just look at some values here. Actually, before we do that, I want to show you something. I would look at this first. This is crude oil over the last year that you can see. And you could see that we had a big peak back here in November, a pretty large trough, another very big climb, another trough, a little climb, and now we are seriously at 1-year lows, because this is well below where we were in November. Now, let me erase this and let me pull up the chart that we're going to see for Oxy. It's very similar. It's very similar. You had that peak in November, you had that big fall, you had that big rise, you had that fall, you had that rise, and now we are down here. We are below this level back in November. So my point in saying this is, you need to understand oil prices. You need, wherever these commodities go, typically the stock price is going to go. So if we just scroll down here and see what we have going on here, 50.38 billion market cap to 92.5 billion of enterprise value. Now, I could typically look at this on a company that, like maybe a UPS or maybe an Apple or Google, and say, okay, that's a very, very, very significant debt. It's nearly double. But when I'm looking at oil, that's why this is hard. That's why you need to go and do more research and not just flying by the seat of your pants, and understand, what does debt really mean in this industry? That's something that you need to find out. So for me, if I'm looking at an oil stock, I'm trying to find experts in this that can coach me through this and understand why is there such a large mispricing. Now, the fact that we are down here, all the way down here, and we're below that November value, we're at a 1-year low. Yeah, I'm going to go take a peek at this. I'm going to talk to people that really understand this to make sure before I do something crazy. Now, if you look at the free cash flow, like we looked at with UPS, crushing net income, absolutely crushing net income. About the same on the 12-month, but the 5-year average, man, is that crushing it. Return on invested capital, about 6%. Again, that could be very skewed because of the industry that it's in. Now, if we come up here, let's look at the 8 pillars and see what we have. See, there's a lot of X's here. Again, I sound like a broken record here, but seeing these numbers, I mean, that's a big discrepancy in free cash flow and revenue. ROIC, I do think that's a little bit skewed. Diluting shares, again, I don't know. This debt number, I'm not really freaked out by it, just in the number in itself. So this tells a story. The 8 pillars tell a story. This story is pretty incomplete when it comes to the 8 pillars. And that is where you need to go and dig a little bit deeper on this one. When it comes to really, not even just oil, gold, silver, copper, any type of commodity, you need to go and pay attention to it. Lithium was huge with the EVs back in the day. Now, you've heard me say a few times that I'm not an expert on this, but that is the great thing about the community that we have. There are people that know a lot about the oil industry specifically. They know a lot about a lot of weird industries that I don't necessarily know about, you might not necessarily know about, and that's the great thing about this community. So if you go to everythingmoney.com, you see that we have a limited number of daily spots for our community and our software. The reason for that is the software, as it exists today, currently includes everything that we have to offer for retirement, real estate, and stocks. As we expand through, we have to make changes, and the offers that we have are going to be separated. The current offer of everything is absolutely going to go away very soon. You may remember when we first started this, Paul had the software built for himself and me to use. And when they saw Paul using it in videos, people would ask, how do I get your software? And I said, you can't get it. It's an expensive endeavor, but it got us to thinking, wait a second here. People want the software, let's give it to them. As the community has grown and as the channel has grown, it is becoming less and less about us and more about how we can better serve you and the community members who use the software. Now, the good news is that these changes have not been made yet, but we're working on them every single day. So if you join today, you'll be grandfathered in for life with all of the data and tools that we've made. You'll get all of it and stay in your pricing tier forever. So if you're really serious about making better financial decisions, probably increasing your returns, but more importantly, sleeping better at night and making less irrational and emotional decisions, click on the link in the description below, get access to the software before we make these changes. I'm very confident that this is going to be one of the best decisions that you've made. Now, let's get on here with the stock analyzer for Occidental. So with Occidental, again, remember, we were talking and saying, this is oil. So when I see these numbers here and I see these values, it's going to be tough for me to go in and say, okay, they're going to do 15% revenue. I don't know, because I'm not super expert in this space, and I'm guessing that you aren't either, and that's a great part about the community. So let's go here to revenue growth. I'm actually going to come and put in here, because when I see this 14% decline, and I assimilate it to that chart that we saw, I don't actually think that this is accurate over the next 10 years. So let's go in here and let's put in a 7% revenue growth number. You know what? Let's do a 6% revenue growth number. Profit margin, you can see the profit margin has spiked. You know that oil is becoming more and more expensive. Let's put in here, let's do 11%. And free cash flow, I'm going to do 11% for simplicity. For PE, I'll do a 15 PE, a 15 price to free cash flow, and a 10% return. Let's click analyze here and see what we have. Well, those numbers that I put in, if you believe or you think that my assumptions are correct, that 6% revenue growth, 11% profit margin, free cash flow margin, PE, price to free cash flow, with a market return of 10%, you're going to match the market. If you bought it today, you're getting a shade over 10%, $56.60. Now we are at 52-week lows. We're below where Warren Buffett was buying the stock. So I think that this is something that you absolutely need to go deeper on. This is something I'm going to go deeper on. I'm actually going to put it a watch list price at $52. Why? Because I want to make sure that I actually remember to go back and hit this, and this is what I'm going to talk about in the community. So before I move on here, I'm actually going to click this, and I'm going to put in here $52 on the nose, not $5, 52, and there we go. I'll be notified on it. Now, the third stock, Boeing. Oh, Boeing. Boeing to me is a company that goes 2 steps forward, 10 steps back. Before COVID, I mean, if we look at this, let's look at the 5-year number here. This was pre-COVID, guys. This was 2019, almost $400 a share. They dropped to a low of, I think it was like $89, $88. I can't believe it, but I bought them at $99 on the nose. Within a week or two, they were at $200. I sold up there. It was purely a trade that I was making based on speculation that a drop from 400 to 88 was totally ridiculous. And it turns out that it worked out, but they cannot get above this 200 number. And all the problems that they've had, the plane crashes, the doors flying off the planes mid-flight. It's been a really, really tough go for Boeing. Now, does that bring on a buying opportunity? Let's check it out. So we look at the current price, it's $154. 52-week low is $151. All-time high, 2019, $446 a share. Oh, all right, let's see. Again, this is a very, very capital-intensive business. If you've been to the airport, you know that. $95 billion market cap, $243 billion enterprise value. Now, the return on invested capital, the last 5 years have been a disaster. It's very skewed. If you look at the free cash flow, very skewed. If you look at the net income, very skewed. So to me, for Boeing, if I was going to go buy Boeing, I would look at this and say, all right, are they going to be around in 5 years? I do believe they are. They have a lot of government backing, and more importantly than the government backing, you have Airbus and you have Boeing. There's not a lot of other commercial planes out there. They are in a monopoly industry. Therefore, they can suck the way that they do. Because what are they going to do? Somebody else is going to come in and take them over? It's very, very hard to create an airline business. It's just not going to happen. So that's why I don't like monopolies. That's why I don't like companies like Verizon, AT&T, T-Mobile. They suck, but they can suck because who's going to come take them out? And when you have Airbus and Boeing, it just is what it is. But that also says, okay, eventually they're going to get better because there's only 2 of them. So when are they going to get better? When is Boeing going to get better? That's the real question. So if we look at the 8 pillars real quick, it's pretty abysmal. But again, you can't go based off of the story of the 8 pillars. I want to go to the income statement, and let's see what revenue they were driving. So they were driving revenue pre-COVID. They got up to $101 billion in a year. Dropped down to 76. There was something that happened in here. I can't remember what it was. Huge drop here. Basically shut down the airlines, couldn't fly. Regained a little bit, but still, where do they settle? Look, I mean, they were doing 90 plus billion through 2018. So they were getting to those levels. The question is, where do they stabilize at? Where's profit going to come from? Where is profit going to come from? You can see net income has just been terrible since 2019. No, it's pretty bad. It's pretty bad. Let's see what they've done with shares. Oh, They've diluted the heck out of the shareholder. So here's this. 2019, 565 million shares outstanding, and they just diluted. And so instead of taking on debt, they just sold shares. So let's come over to the metrics page, and let's just look at this discrepancy again. 95 billion versus 243 billion of enterprise value. That difference right there is the debt. So instead of taking on more debt, they issued more shares, hoping that they would raise money that way instead of having to take on debt. So, but again, it's a slippery, it's a hard place to be. What do you do? Is it better to take on debt? Is it better to dilute yourself? It's a flip of a coin, especially when it comes to an industry like this. Remember, they were shut down for quite some time. It's just like the cruise lines. If you look at Carnival Cruise, Royal Caribbean, same situation that they're in. Let's go to Stock Analyzer. Let's put in some assumptions here for Stock Analyzer. So I'm going to assume, now this is a tricky one. We're going to make this assumption over the next decade. So let's say that the next 4 to 5 years are rough, okay? Let's say that they don't do any revenue growth. Let's say they just stay flat. What happens after that? They do 2%, 3%, 4% on average over the next decade. I'm going to put in 3%. I'm going to give them the benefit of the doubt. Profit margin, this number here over the last decade has been decimated by the last 5 years. So I'm going to put in profit margin of, I'll go 2.5%. Free cash flow margin, I'm going to do the same. I assume those will reach each other. I'm going to do an 18 PE, an 18 price to free cash flow, and a current desired annual return of 10. Now, again, I don't know if this could be skewed, but current price is 154. Looking at it at 47, you're going to get a negative return if you buy it today, obviously. I think for me, I would start looking at this. I'm going to put $75. And you're probably looking at this saying, well, why $75? It's not going to get to $75. Well, first of all, it could absolutely get to $75. Second of all, I'm not dying to own this thing. So if it gets super, super, super cheap, then I'll go and look at it. If it doesn't get super cheap, I'm not really that interested. Now, if you want to watch the last video of 3 stocks near 52-week lows, click this card right here. You guys will enjoy it. Have a great day.